that. We are representing the Alliance for Financial Inclusion and the University of Luxembourg today. And in this discussion today, we will talk about measuring inclusive green finance. The objective of our panel is to take stock of the progress and the impacts of inclusive green finance, as we have heard this morning from the Prime Minister of Belgium, that this year's COP topic is essentially to learn how we can finance the green transition. So we want to discuss 3 points today. The first one is how can regulators develop and implement key performance indicators for IGF policies, inclusive green finance policies. Second, we want to learn how the private sector can use these key performance indicators and to demonstrate the impact of what they are doing. And third, we want to showcase the need to bring accountability to the debate around inclusive green finance and to quantify impacts of climate finance flows in inclusive action. So our collaboration, as I said, is between AFI, the Alliance for Financial Inclusion, representing 90 institutions, central banks and financial regulators of developing and emerging economies, with its European representative office in Luxembourg, which is the reason why we're standing here today in the Benelux Pavilion. We're very grateful to be able to share our case here. And we collaborate with the University of Luxembourg, to which I also belong as an assistant professor. And we are very happy to have invited guests from our AFI member countries, as well as Professor Dirk Zetsche and Helen representing AFI, to lead the discussion today around the topic. With this, I first want to hand over to Dougal, representative of AFI. He's the head of the communications unit in the AFI management unit, and I'm happy to hear your welcome words.
Thanks, Julia. Hello, everyone. So for anyone unfamiliar with AFI, we are a policy leadership alliance owned and led by 90 central banks and financial regulators. And you might wonder, why are central banks and financial regulators at COP29? Why are they meddling in climate issues? Well, the short answer is they have no choice. They have to. And that's because around the world, the impact of climate change is now posing a very direct, severe, and very real threat to financial stability. And in the face of that threat, central banks cannot afford to be passive. And one way that they can be active is through inclusion. And today, 69 members of the AFI network are working on our working group on inclusive green finance. And this is an approach which supports climate resilience and emissions reduction and the transition to a green economy by greening the financial sector, by expanding access to financial services, and by helping vulnerable communities build resilience to the impact of climate change. Last year, in partnership with the University of Luxembourg and others, AFI launched the Roadmap for Inclusive Green Finance implementation, which details the building blocks for a successful IGF framework. In September this year, we published version 2 of the roadmap, which reveals how Bangladesh, Ecuador, Egypt, Papua New Guinea, the Philippines, and Zambia have implemented inclusive green finance, looking at their approaches, their strategies, their policies, the challenges, and the lessons learned. So if central banks and financial regulators are at COP29, if our members have traveled from Morocco, Mongolia, and Bangladesh, it's because they know how important it is to speak up for inclusive green finance. And they know that it works. But how do we show that it works? Well, that's going to be the topic for the next hour or so. Last year, at COP28, AFI and the University of Luxembourg organized a side event which highlighted IGF's contribution to financial stability and market efficiency. And this year, we're taking it to another level entirely by looking at aspects of measurement, data, and impact. So with that, let me conclude by thanking our partner, the University of Luxembourg, as well as the like-minded funding partners who support AFI's Inclusive Green Finance workstream, notably AFD, the French Development Agency, and Canada's International Development Research Centre. And as Julia mentioned, I also want to thank the government of Luxembourg who made it possible for our delegation to be here by hosting this important event in the Benelux Pavilion. So thanks to them, thanks to all of you for working with us to keep inclusive green finance high on the global climate agenda. Back to you, Julia.
Thank you very much, Tugal. Thank you for your welcoming words. Before we start with the presentation of Najwa Mouhauri, she's the head of green finance of the bank in the bank supervision department in the Bank Al-Maghrib. So she has close to 10 years experience in banking supervision with the Central Bank of Morocco and coordinates in this role the implementation of the Moroccan Roadmap on Sustainable Finance. She leads the work of the Central Bank on climate-related risk monitoring and supervision and contributes thereby actively to the work of regional and international groups on inclusive green finance and sustainable finance. Najwa, before I hand over to you, we quickly want to show a short video on the matter of inclusive green finance, and I already yield the microphone to you. We are looking forward to your valuable insights from the Central Bank of Morocco.
For small farmers like Lena, her knowledge and experience help her solve most of her problems around her farm. But in recent years, climate change has created new challenges that go far beyond her control. Extreme heat, droughts, and wildfires are threatening her ability to make a living. So, how can we protect farmers like Lena from the impact of climate change? The answer is simple. It's called inclusive green finance, and it can help farmers like Lena build resilience against climate impacts. For example, by giving them access to emergency government assistance, climate risk insurance, or loans to invest in sustainable farming techniques. Inclusive green finance is taking off around the globe thanks to the commitment of the AFI network. Through this initiative, central banks and financial regulators are helping to protect individuals, communities, and economies from climate impact. If you haven't already joined the cause and promoted the inclusive green finance, now is the time to act.
Good afternoon, everyone. Hope you can hear me well. Yes? Okay. I am very pleased to be taking part to this session on the first day of the COP29 on behalf of AFI, but also of Bank Al-Maghrib, which is a member of the Inclusive Green Finance Working Group since its inception in 2019. So today I'll try to share with you what we have been doing in the Inclusive Green Finance Working Group when it comes to measuring inclusive green finance. But before that, let me recall how important can inclusive green finance data be, more importantly for emerging and developing countries that are mostly exposed to climate-related risks and disasters, and where also the underserved and poorest population are unevenly affected by climate-related risks. So with this in mind, we are all mindful of the need to develop an inclusive green finance data and revealing disclosures, which are actually key to identify, assess, and manage climate-related risks for these specific segments. Next slide, please. So this brings me to the purpose of the special report of AFI on inclusive green finance data and measurement. So the purpose was really to explore the intersection on the one hand between the green finance approaches and on the other on the supply side financial inclusion indicators. So this report also identifies AFI members' priorities when it comes to implementing internal reporting frameworks on inclusive green finance that may be relevant for both regulators that are responsible for financial inclusion and climate change development agendas. The concepts covered in this report may also convey indicators for greening national strategies for financial inclusion. So through the Inclusive Green Finance Working Group and the Financial Inclusion Data Working Group, AFI members have been increasingly responding to the need for inclusive green finance data through several policy frameworks, but also ways that include aspects such as target setting, availability, funding availability, disclosure requirements, measurement methodologies, both qualitative and quantitative ones, and last but not least, dissemination approaches. Next slide, please. So this brings me to the key areas of focus that inclusive green finance data should capture or also address. First and foremost, how adequately and efficiently financial institutions related risks within their risk management frameworks, while adding SME, micro institutions and individuals' lenses to these risk management frameworks and risk assessment capabilities. So in order to produce on climate risks, financial institutions to integrate climate risks in the risk management framework, but also develop revealing reporting and disclosure frameworks on climate-related risks. So the second area of focus that inclusive green finance data should capture is really how the availability of funding for inclusive green finance initiative, and last but not least, how much volume on the supply side we have to finance and support and provide financing to inclusive green finance initiatives. Next slide, please. So, a rapidly increasing amount of sustainability linked and inclusive green finance data is needed going forward and should be available thanks to revealing disclosures, increasing requirements on disclosures. So we need to close the data gaps through more requirements on climate-related risks disclosures and through more broad dissemination approaches. We should also cooperate with other agencies. Cross-agency cooperation processes are needed both at the national and international level to also be able to leverage international activities in this space. And last but not least, we should have a common baseline framework when it comes to disclosures and data on inclusive green finance. It would help to form a reliable, comprehensive, and comparable picture at the international but regional levels. Next slide. Yes. So this brings me to our inclusive green finance progress measurement framework that we have been exploring within the AFI members in the Inclusive Green Finance Working Group. Next slide. So we have explored and studied the key building blocks for an inclusive green finance strategy, roadmap that specific. Also thought about tracking the progress towards implementing the inclusive green finance framework at the national level through a country classification, through different stages from the early stages to the maturing development stages, more advancing to implementing inclusive green finance, enabling environment, policy frameworks, and regulators. Next slide. Yes. So the key building blocks that we've explored within the roadmap for inclusive green finance are really to adopt an inclusive green finance strategy while prioritizing, setting the priorities at the jurisdiction level. Building the inclusive green finance ecosystem is also key. We should have the enabling environment, the necessary incentives through specialized data and approach, but also classifying and prioritizing the key items and components of this strategy. And last but not least, data and methodologies are key to capture both risks and opportunities of inclusive green finance. So this brings me to inclusive green finance measurement framework upon earlier in the earlier slides. So we should be able to develop financial regulators actually have a key role to play to coordinate, promote, and support financial institutions develop risk assessment capabilities and integrate climate-related risks that would contribute to their soundness and to their robustness, which is a general precondition for financial institutions to provide in a stable manner financing, including towards inclusive green finance. So the second key area of focus would be to funding inclusive green finance initiatives. And as I have already said, we should be able to capture data insights about the sources, the availability, the performance of inclusive green finance investments, but also how much funding is available at the national level. Identifying the key actors involved in inclusive green finance transactions is also key to capture the potential data and information sources to be able to capture the flow of inclusive green finance that may be happening in a specific jurisdiction. Yes. So this classification would enable us to really set members in different development stages, starting from the initial phases and the early stages of really exploring what are the priorities, what is the key policy framework, the common principles that should be implemented to make sure that we have a common coordinated approach towards inclusive green finance at the national level. Then we will have the progressing members that are moving forward through setting guidelines on ESG, on climate-related risks, inclusive green finance promotion, but also risk assessment and management. And the last phase will be to have members that are advancing and moving beyond setting the guidelines and having a clear sustainable finance regulatory framework and a very structured approach towards inclusive green finance and mobilizing the full capacity of financial sector towards sustainability and inclusive green finance. Thank you.
Thank you very much, dear Najwa. I think your engagement for inclusive green finance became already obvious by the fact that you've been traveling all night to give us these wonderful insights without any sleep. I learned a lot, and I think this is a wonderful example on how AFI provides, or the AFI members on their own work for a common framework. They work on it based on science, on proper methodology, to then use it in order to peer learn from each other. And I think that's a valuable exercise and a lot that all of the countries in the world can learn about. What are we doing next? For the next 45 minutes or so, we want to have a discussion between all members of the panel. Let me start with you, Najwa. What are the insights from the Bank Al-Maghrib on the importance of data and scaling IGF?
Can you hear me well? Yes. Okay. From Bank Al-Maghrib's perspective, inclusive green finance data is really key to identify socioeconomic impacts of climate change, because in many developing countries, such as in Morocco and many African countries, agricultural sector is having high socioeconomic relevance and is at the same time highly sensitive to climate change patterns. So capturing inclusive green finance data would help us as a regulator to have a comprehensive view on the exposures of the financial institutions that we currently supervise, while also capturing the key transmission channels to the financial sector through these socioeconomic dimensions that may exacerbate the impacts on the financial sector. So we believe that having the inclusive green finance data is not an easy task. Supervisors will likely have to make some substantial efforts, concerted efforts to capture climate-related risks, practices, risk assessment, but also green finance provision and funding to specific segments, since the data is really lacking at this very granular level. But we need to make an extra effort to make sure that we properly advance and monitor inclusive green finance at the national level.
How do you, or how can you explain from your perspective, how is the Bank Al-Maghrib measuring climate change impact the banking sector, hands-on?
Yes, actually, this was the third step that the central bank took towards integrating climate-related risks into the supervisory framework. So it took us 2 years to really collect sufficiently granular data at the sectoral and geographical level to assess both physical and transition-related risks. But then it helped us also explore some of the numerous difficulties that the financial institutions and specifically banking institutions that we currently supervise may face when it comes to assessing the risks. So we have we went through a 3-phased approach. The very first step was really to assess in a qualitative manner the key transmission channels, the specific climate risks that may be relevant in the Moroccan context, to study the historical climate events and their own impacts on the balance sheet through data collection, interviews with national relevant stakeholders, but also proxies, because to overcome the lack, to bridge the data gaps that we were facing by that time. Then we moved to the risk assessment through both a bottom-up and top-down approach to have the sectoral level losses, GDP impacts, but also produce impacts on financial aggregates, a bank-by-bank basis on both physical and transition risks. And here again comes the critical importance of models after data. Once you have the sufficiently granular data, you should be able and have the necessary expertise internally, or the partnership, as it was the case for the Central Bank in Morocco with the World Bank, that helped us a lot bring in this international expertise to Bank Al-Maghrib to assess climate-related risks. So we have been able, and it made it possible for us to have a Morocco macroeconomic modeling approach that was taking into account the specific economic and financial sector structures and enable us to really capture the interplay between transmission channels, specific highlighting the risks, but also how the direct and indirect impacts of both flood and droughts could propagate to macroeconomy and then to the financial sector. So the credit market, public finance, and financial aggregates of financial sector were all interacting in this macroeconomic model that was developed by the World Bank, that in turn also has leveraged external expertise from universities, because the expertise was lacking for the physical risks. And this brings the issue of adaptation, the need to really assess the physical risks and the adaptation finance that will be supporting mitigating these risks and enhancing climate resilience in developing countries. So we had been struggling, but it was made possible thanks to partnership with national agencies, but also international expertise, scientific community, and also universities to have this model. And the last step was really to stimulate the potential future impacts on NPLs, capital adequacy ratios. And here again, it was on a sectoral level. We had both a macro and micro prudential focuses, while the specific focus and purpose was really to acquire knowledge, to help the banking institutions build the capacities, to provide some numbers on their exposures that they could leverage internally to put in place some further analysis and also mitigating actions to reduce their exposures to climate-related risks. On the transition side, we were constrained by the lack of data, sufficiently granular data, so we have only explored 2 different carbon taxation scenarios, but also the alternative scenario of the carbon adjustment, border adjustment mechanism at the European frontier that may impact also the Moroccan exporting activity, as Morocco is one of the key commercial partners of Europe. So this was our approach towards assessing climate-related risks, and we strive to more granular analysis, maybe go into the inclusive green finance specific segments while trying to close the data gap, but we are mindful that this may take some time, but we should make the effort without waiting. Thank you.
Very interesting to follow your regulatory path towards inclusive green finance and also to see the challenges that you have been facing. We have the great honor on this panel to have not only one expert in going in this way and giving us the first footsteps, but more than one. And with this, I'm also very happy to welcome Ninjbatgar Kishigbatara. And Ninji is a senior officer in Research and Development Department of the Financial Regulatory Commission in Mongolia, and she conducts in-depth capital market research. She analyzes market trends in the field, prepares thereby quarterly market outlook reports, and develops financial, legal, and internet and jurisdictions for commodity exchange activities. Ninja is also very active in sharing what she knows. So she publishes the Inclusive Finance Monthly magazine on topics such as green finance, regtech, fintech, and international market reviews. Welcome to the stage, Ninji. And we're looking forward to your insights concretely on how Mongolia, as one of the first countries to come up with the green finance taxonomy, mainstreaming the understanding and measuring green finance, is tracking the progress and the flows of IGF in Mongolia.
Good evening, everyone, and thank you. As we all know, climate change is no longer just an environmental concern. It's having a significant impact as economy and financial systems, creating real risks. The world financial system, along with the participants, is feeling this effect both directly and indirectly. This includes the performance of the stock market, the viability of the investment product, and even the ability of companies to repay their debts. The global trend of moving away from the carbon-intensive sector is also compelling us to rethink and transition our economic activities. Recognizing these challenges, the Mongolian government, alongside financial regulatory authorities, is focused on the integrating climate risk concentrations into financial decision making. We are aiming to channel both public and private funds towards reducing carbon emissions and implement macro-prudential policies to mitigate climate risk. Our commitment is reflected in key nation policies such as the Vision 2050, long-term development policy of Mongolia, which emphasizes developing environmentally sustainable green financing. This priority is also highlighted in the reform and development program of the financial market until 2025 and the framework of the government's monetary policy in the 2024. In recent years, we made a significant strides. In 2019, we approved Mongolia's first green taxonomy. We followed the National Sustainable Finance Roadmap of Mongolia in 2022. And most recently, Mongolia Sustainable Development Goal Financing Taxonomy in 2023. The approval of the SDG Finance Taxonomy was a milestone of the registering and reporting contribution of the any finance and investment of SDGs and increasing investors' trust. It also has the advantage of having a taxonomy that covers the scope of 17 sustainable development goals, as well as indicators measure the results. The National Sustainable Finance Roadmap set out the goal of increasing the green loan portfolio of the banking sector, ranking 10% of 2030. By the first quarter of 2024, this portfolio has risen to 875.3 billion MNT, conducting 3% of the total loans. The issuance of the green loan in the first quarter of 2024 has surged by 2.3 times compared to the previous year. And Financial Regulatory Commission has working at the international and domestic institutions including Mongolian Sustainable Finance Association, International Finance Corporation, Alliance of the Financial Inclusion and European Bank, and for the creating long-term sustainable financing system, a green capital market, and the regulatory inventory for the green bond issues. The cooperation between governments and non-governmental organizations and financial institutions is important, and the participation of the Mongolian Sustainable Finance Association is important. Thank you.
That was very insightful. So what are the challenges in measuring green finance in your country? Now that you outlined that you're very strong in tracking the progress and the flows of IGF, what are the concrete challenges that you encounter when you measure green finance?
Recognizing these challenges, Mongolian government alongside financial regulatory address is the focused on integrating climate risk consideration into financial decision making, and we are aiming to change both the public and private funds toward the reducing carbon emissions and implement macro-prudential policies to mitigate climate risks.
Thank you very much. And I want to hand over to who started working in bank supervision, Sustainable Finance Department in Bangladesh Bank, contributed to the policy formulation and supervision of the banking industry, and passed through the various departments of to be highlighting the fact could
Slide change. Thank you very much. Actually, in the earlier event, Prime Minister of the Belgium highly focused on the finance for the climate change, especially on the climate change adaptations. So why Bangladesh Bank is eagerly implement the sustainable finance policy and the green finance policy? Because that the Bangladesh, as you all of you know, that the Bangladesh is the recognized as the 7th most vulnerable country to the climate change by the IPCC. And over the first 30 years, the country has faced experienced the significant temperature rise of the 0.56 degrees Celsius, resulting the frequent super cyclone, severe droughts like that. And Bangladesh government also has made a remarkable formulated the policy for overcoming the climate change activities, like as the Bangladesh Climate Change Strategy Action Plan, Bangladesh Climate Change Trust Act, Bangladesh Climate Fiscal Policy, National Adaptation Plan, Delta Plan, like that. So, for assisting the Bangladesh governments or in its commitments to the fostering the financial inclusive, as a central bank, as a regulator of the financial industry, Bangladesh Bank has taken a lot of initiatives to attract to engage the effectively private finance in the sustainable arena and the climate arena. Actually, Bangladesh Bank started its journey since the 2011 by giving the some policies. This is called the green banking policies and the ERM, environmental and risk policy, and also. Bangladesh in the year 2014, Bangladesh Bank giving the lending quota to the banks and finance company, which is the 5% of the total term loan disbursements should be the green finance or the green infrastructures. And also we give the instructions to the bank and finance company to set aside the 10% of their CSR budgets to the climate risk fund, which uses the voluntarily or the to the vulnerable people in the coastal area as a grant base. And in the year 2017, we issued a guidelines for environmental and social risk management guidelines, including the generic environmental and social due diligence checklist. And after that, in the year 2022, we again revised our environmental and social risk management guidelines, focusing with the 10 vulnerable and specific sectors, including the generic one. And to ensure to enhance the private sectors, we issued the sustainable finance policy for the banks and finance company. And in the year 2023, we again revised our sustainable finance policy for aligning or for attracting the private sector engagement, especially the climate change adaptations in our country. And the policy includes the 14 sectors and the 94 products. That means that we are clearly defined the sustainable finance, green finance, and the climate finance clearly. And to motivate the banks and finance company, we introduce the sustainability rating for the banks, and we regularly disclose the top bank for the sustainable finance or the clean finance in our website. And in the year 22, we issued a bond policy. That means the guidelines on green bond policy for banks and funds. As you all of know that the banks are collected the short-term liabilities, but they invest the long-term investment for the climate change adaptation or the climate mitigation projects. So there is a huge mismaturity. For minimizing the mismaturity, this bond guidelines is creating a great potential to the banks and finance company to raising the fund by the long-term basis. And not only that, as a central bank, to promote the sustainable finance, green finance, we have established 3 refinance schemes. One is the Green Transformation Fund, this fund are created only for the procurement of the green capital machineries. And another one is the technology upgradations and the development fund. These funds is created only for the exporters who willing to develop or upgraded their machineries in like the energy efficient machineries or the energy like that. And also we have established the refinance scheme for the green initiatives. And here you see that after our initiatives, what's the situations and what's the scenario of the sustainable finance and green finance. We have given the lending quota to the bank, and in the year 2023 we already achieved the lending size. Now we again giving the banks and finance company lending quota. That means that we increase the lending quota, that is the 40% of the total loan disbursement. And though sustainable finance covers the climate financing, but being very vulnerable to climate changes, Bangladesh Bank is developing the climate finance policy, incorporating the climate footprint measurement, carbon accounting like that. And also, we are going to launch a green credit guarantee scheme shortly. Thank you very much.
Thanks a lot for your insights. I think it's particularly impressive that you've been dealing with these issues or started dealing with these issues at a time where most other regulators were still concerned with the effects of the global financial crisis. So you rely on almost 15 years of sustainable finance expertise, and that was very insightful. Maybe a short add-on. How does Bangladesh Bank prevent greenwashing in the banking and investment activities?
Thank you very much. Actually, this is the main challenges, the greenwashing. How do you prevent the greenwashings? So we have taken some points or some indicators that I show in the slides because I said earlier we clearly define in our taxonomy the sustainable finance, green finance, and also 94 products under the 14 sectors and the 88 activities under the 8 sectors for the green bond taxonomy, and another one is the exclusion list. We have given exclusion list for screening the sustainable finance. So if any bank go to finance before this finance either qualify or not, that means that you must go through the exclusion list, and we regularly continuously monitoring and the conducting on-site supervisions and the off-site supervisions through the quarterly report. And we also focusing on the certifications of the third party and also the sustainability and climate related disclosures, and the lastly the capacity building development and the finance of the banks and finance companies. And also we are conducting frequently awareness raising related workshops. Thank you.
Thank you very much, Chaudhary. So I now want to invite Helen Walby. She's the lead of the global partnerships at AFI and thereby responsible for leading AFI's global fundraising and advocacy efforts, developing strategic partnerships and positioning the work of the AFI members within the global ecosystem. Helen, as you have the overview of all of your member institutions, what is AFI's perspective on IGF contribution to the realization of Article 2.1c of the Paris Agreement? For all those that do not know by heart the Paris Agreement, this provision is referring to the tracking of finance flows towards the Paris Agreement.
Thank you. For the purposes of time, I'm going to keep my answers very brief, but if anybody would like to connect with me afterwards, then I'll be able to stay after the session. It's been great that we've been able to hear from some of our members on this, but we can really see that the work that the AFI members are doing really does align finance with climate resilience development. We can see that the flows really do help mitigate climate change, and they also enhance resilience throughout our membership. So we can make sure that this dual objective really does align with the work of the Paris Agreement as well. We can also see that the work that has been done through our members really does guide financial resources towards both climate change adaptation and towards mitigation. So this really does help reinforce the transition towards a low carbon climate resilient economy. We can also see that the work of the membership is around supporting adaptation alongside mitigation. So it's very important that we focus on vulnerable communities to ensure that nobody is left behind. And we also need to be able to, I think we've heard from our members, have different types of approaches for the different types of needs within the communities that we're serving. We can also see that we need to make sure that we integrate adaptation into financial products. I think we heard from Paul when he was talking on the session that was running earlier today about the importance of understanding the different needs and also making sure that that finance is really mobilized for different groups. So we need to have really good data to be able to understand those needs and then be able to develop things that serve those groups particularly, because they, especially when you have people who have intersectional barriers, it's really important that we take their needs into consideration. We also can see that it promotes a very fast transition to a low carbon economy compared to not working through the inclusive realm. And we can also see from the work that we've heard our members talking about that the work really does encourage the development of policy frameworks and regulatory support. And this means that our members are able to provide really strong national structures, and they can also ensure that they build the capacity within the whole ecosystem. So I think one of the things that Paul was talking about earlier was scale, scale, scale. That was his wish out of his panel. And we can also see that the work that our members are doing on inclusive green finance really does build quite a solid foundation for scalable development. So that's a very brief run through on the alignment with 2.1. Thank you.
Thanks a lot, Helen. With that, and to wrap up this panel, I want to invite Professor Dr. Dirk Zetsche, professor at the University of Luxembourg in Financial Law and Inclusive Finance, to give us your insights on the importance to measure the impacts of IGF and your key considerations in identifying the indicators of IGF impacts.
Thank you very much for handing over. Ladies and gentlemen, we have so far a key insight. What we cannot measure, we cannot manage. We need to know how to generate the impacts, and the sole reason why we care about inclusive green finance is because of the impacts that we want to generate on behalf of mitigating the impact of climate change, in particular because in the developing economies, in the emerging markets, this is where the focus lies. Of course, the impacts are manifold and diverse, and in this regard, we have the issue, so to say, to focus. Because if we want to focus on all impacts, it's probably too much. So we need to pick out the priorities of each country and focus on that. In some countries, it's too much water. In others, it's not enough water. In some countries, it's a rainforest that is our main concern. In others, it's a desert. Yeah? So the world is diverse, and that means our impacts must be diverse. Next slide, please. In this regard, Jen, next slide, please. In this regard, it is crucial that our data is organized by financial and non-financial data, and whatever the concern is, we need to know what impact we want to aim at and measure these data. For instance, a good impact measurement is when we want to deal with gender, that we look at the gender ratio of certain loan programs. This is something that has become an enormous efficient tool to integrate SME businesses, in particular in rural communities, usually driven and run and operated by females because they are not migrating. Next slide, please. In this regard, it is really crucial that our data focus on certain impact frameworks which come with one important aspect. It's not always about accuracy. It's much about tendencies. It's going in the right direction. And that's very important because when you want to have absolute accurate data, your framework will be extremely expensive and tedious to operate. So you need to find good measurements, good proxies. And these good proxies need smart regulators. Smart regulators are those that question themselves, that kind of go back to zero and say, do we ask the right questions? Or is it a cheaper way to get the data set that we want? We need the best proxies to get there. And for instance, these gender data are a good indicator. Another aspect could be, for instance, that certain particularly harmful sectors shrink in importance over time. So there are various ways to do that, but the smart regulator is a regulator we need. What are the principles? Comparability is extremely important so that you can compare the sectors you're operating in. It's very important that you identify the trend. The trend is your friend. That is very important. When we move in the right direction, there's something like a fashion coming up and people will follow. And the aspect is that you give guidance, that you tell them what's right and what's wrong. Don't be shy, but that also means you have to correct yourself and you see you go in the same direction. That means be open, be transparent, justify and discuss. So in a way, the ideas of a regulatory sandbox, which means regulators should be open to innovation and learn, is also true for this type of impact measurement that we're engaging in. And finally, the data set that we ask for must be locally optimal. That means it must consider what data can be gathered, what data is available on the ground, and which data can come from the SMEs and which must come from public sources. Not every data can come from the SMEs, or let's say only one or two very simple data can come from the small SMEs. The rest must come from other sources, and here it's crucial to combine these different aspects in one coherent framework. And I've worked a lot in my research with the impact data, and we put them in proportion to all kinds of financial soundness indicators. But when we don't have the data, we cannot even say whether anything what we do matters at all. With that, I thank you very much for your attention. I hope that we engage in further discussions, because it is a difficult question, but when we do not start, we can never finish. Thank you very much for your attention.
Okay, thank you very much, Dirk. That was more theoretical from, and very helpful to have it in these abstract terms after we have seen the more concrete applications. With this, I want to open the floor to the audience and ask you if you have questions to our panel. If that is not the case, I would like to... there is a question. Very good. Sorry.
Thank you so much. My name's Abili Katontoka. I'm the NDA for Zambia. The issue of impact green financing is something that is commendable. What I just wanted to understand or even ask is, how do you deal with the issue of impact washing? Instead of greenwashing, but impact washing. I know we're talking about setting KPIs on how to measure the metrics of IGF, but how are we going to deal with the issue of impact washing? Thank you.
Thank you very much. Thank you. Who wants to reply first? Dick.
I think the regulators will follow afterwards, but I think the main important part about all kinds of fraud, and impact washing is a type of fraud, is that we test it by neutral sources. And I guess from my perspective, testing any type of closure against neutral sources is of utmost importance. What can these neutral sources be? They come from academia, they can come from statistical offices, they can come from a kind of peer review from other parts of the industry. So when you have neutral sources, you can run whatever disclosure comes against the norm statistically, and when you have the outliers, you go for enforcement action. That means you go into them and ask them, what is your methodology? Where do you have your data from? What have you done to get there? So for me, it is a statistically easy way to identify the outliers, and then the regulators have the resources to basically focus on one or two bad actors. You take them up as a kind of bad symbol, and then the market will get a warning sign that they have to have proper conduct rules to identify the raw data with which they justify the impact. I hand over to you.
Thank you. Actually, I show my slide as how we prevent the greenwashing, because every bank and finance company, because we regularly show in the sustainability rating in our disclosure. So every bank have to achieve or have to show their name in the disclosures. Oh, that's why actually my central bank we develop some regulatory template and we give them, and from this template actually we collected the data. So there is no scope. They this and that way manipulated this data. And not only that, we regularly conducting the on-site inspections and the random inspections regularly basis. So they are always afraid of to giving the data to the central bank. Thank you very much.
Yes, just to echo what has just been said, in the Central Bank of Morocco, we're not yet to assessing the impact that banks have already captured internally. We are in the supporting phase where we are providing the exposures that we have assessed with the support of the World Bank, and then we are requiring more revealing disclosures from the banking institutions following the recently issued ISP disclosures. That should help us to also have this common baseline across banks in the Moroccan banking sector, make things comparable at the first step, and then, as it was perfectly said, the central bank has many powers on banking institutions, on the financial institutions more broadly, because you can go into on-site, off-site supervision, you have supervisory dialogues, you can actually verify the accuracy and the compliance of what has been disclosed or reported to the central bank to judge whether that would be an impact washing or that would be really relevant, accurate information. Thank you.
Maybe was just one thing. An ever existing issue in enforcement is mass non-compliance. So it's important to single out the bad actors who are really the worst in the industry and make an example with them. Yeah? And that is usually then increasing discipline across all the market. But that is a general issue of regulation, that a regulator has limited resources, so you cannot go after every bad actor, but you need to identify one or two really bad ones and really take them. One other thing where impact washing usually comes from is not so much the financial institution, because they are supervised, but the ones who are not in the regulatory thicket, and they are reporting upwards in order to get the benefits of an apparent green thing. And there my recommendation is simplify the type of data you rely on. The more complex your taxonomy, the more complex your data framework, the more impossible it is to supervise. So my suggestion for, in particular, SME finance is a 1 or 2 factor impact scale. That means they shall say, not we are green. That's impossible. But they shall say, we reduce carbon dioxide emissions by 80%. And when it's a bakery, you can ask them, well, you have all these coal-fired ovens. How did you do it? Well, we switched to gas. Okay, that's working. Yeah? So it's important that as a regulator, you ask simple 1 or 2 factor questions which are easy to monitor and which easily run a plausibility check. Because here you can ask, please give me the invoice where you have where you went from coal to gas. Yeah, and so it's very important also to understand that in the developing economies we're working with, we're not talking about running a super green car and replacing it by an even more green car. Yeah, we are running basically from brown to a little bit of green. Yeah, and that is of course 80% better than before. Yeah, when you go from a green to a super green car, you go from 99 to 99.5%, extremely costly, but yeah. So as a regulator, you go for where the impact is, and where the cost and the benefit. That's very important. And then you have also capacity for enforcement action.
Thank you. Other questions? Follow-up question.
Sorry, maybe someone else would like to ask, but I want to, maybe Morocco can highlight further on this question or any other one on the panel. And this speaks to the unique financial sector in most emerging countries. The issue of high cost, I prepared my questions, so. High lending costs. That could be maybe a barrier for financial institutions to go the way of inclusive green financing. How is that being how is the, okay, even IGF can answer the question. High lending costs, how are you helping your member central banks achieve sort of concessional lending so that financial institutions can then push the agenda of inclusive green financing? And then risk evasion. Okay, so this is tied to risk evasion by financial institutions, because where I'm coming from, the cost of borrowing is quite steep. And then you're given, on top of that, you're given the guidelines to say green loans should be like this, but you are lending from your balance sheet where you've borrowed at high cost. And then how do you say, how do you manage that? And then the issue of limited awareness and understanding of what a green loan is, which the professor spoke to when talking about SMEs. Some of our economies are driven by SMEs. They have no idea, no understanding what green financing, sustainable financing is all about. How is that managed? The experiences, we've had good experiences, frameworks are being put in place, but what sort of education is going on to the grassroots for them to be able to be the adopters or the ones that promote or cause the initiative of green financing moving forward? Thank you.
Thank you for the questions.
Very much.
One is the question is that the high cost. In our experience, if I show the line how the increases our green finance or sustainable finance, this is very much impact only for the creating the 3 refinance scheme. This scheme a very low cost. Right now in our industry, interest rate is 14%, but Bangladesh Bank giving the loan from this scheme only 1% to the banks and FI and 5% to the end borrower level. So that's why they are increasing the green finance. And other one is that the sustainability rating. We implement the sustainability rating, so banks and finance company to run aware to see their positions in the top. And third one is that we created a fund that is called Climate Risk Fund. Every climate risk fund, CRF, Climate Risk Fund, every bank should have a budget for the CSR. Out of the CSR budget, 10% of this CSR should go to the CRF fund. And banks would likely to finance from their own sources by supporting the subsidized price or subsidized loan to utilize the CRF funds. If, say for example, if the bank and finance company to give the finance at the climate change adaptations initiatives, but its bank's rate is 14%, but bank should charge the 6% or 7%, and the remaining 8% they should utilize from the CSR budget. Thank you very much.
Thank you. In Morocco, the approach is completely different. We are exploring the potential of a green refinancing mechanism, which is actually the mostly relevant instrument or incentive one central bank can provide in the emerging developing countries is actually direct allocation instrument through monetary policy. But there is a necessary precondition to have at the national level. It's a green taxonomy. As long as we don't have a green taxonomy, we cannot condition lower financing by financing green activities, since we haven't defined yet what we mean by green assets, green investments, and green activity. But what we have been doing to incentivize the uptake of green financing at a lower cost is actually by reflecting climate risks in the portfolio of banks. We are integrating climate risks in the supervisory review and evaluation process, and banks are getting a rating depending on to what extent they are sufficiently taking account of climate risks among other components of the supervisory review and evaluation process. And ultimately, they could have to also constitute capital buffers under Pillar 2 to cover these risks, which would in turn be more costly for them to invest or continue investing financing brown activities, non-environmentally friendly activities, and then turn indirectly into green investments or activities. We have also a new green finance strategy, a system-wide green finance strategy that was developed by the Ministry of Finance with the central bank and financial regulators, which is also exploring some of the key incentives to lower the cost. But from we stand today, we've had many green financing lines by leveraging international resources. We have MBDs that were implementing some incentives through cashbacks to banks that will be mobilizing green lines or green facilities in many corporate segments, including the MSMEs. There is one other instrument that could be relevant in the developing emerging markets context is public-private partnerships. In Morocco, we've had the experience on financial inclusion of MSMEs, and we had a national financing mechanism involving the central bank on the one hand, the Ministry of Finance, the guarantee scheme, the guarantee agency, national agency, that were all putting instruments in the table to make sure that banks are providing financing to MSMEs, because the central bank is providing at a lower cost and conditioning this lower cost by providing financing to MSMEs. This was straightforward, as we already have definitions what we mean by MSME at the local context. So this is the experience of Morocco. Yeah, you've raised also, and the second part of your question was about awareness raising for MSMEs and enterprises. As a central bank, we have been pushing banks to develop green finance offers, and during the supervisory dialogues and meetings we have periodically in a regular manner with banks, there is a issue that came out frequently, which is we develop a green finance line, but we have no demand for this. So we need to close this and go for traditional financing mechanism. And then this is how we engage the central bank, because it's not within our mandate to stimulate the demand for it. Is actually a more public policy thing, or from spatial agencies at the national level. So while drafting and designing this new green finance strategy at the national level, we have been insisting on having one key enabling environment, which is to stimulate the demand from the enterprise's corporate side, to make sure that once the financial institutions is providing its contribution and mobilizing its full capacity towards sustainable development goals or climate action, there is also a demand from enterprises. At the national level, Morocco is also implementing some public policies in this space to green active MSMEs and enterprises activities as a response to the carbon adjustment mechanism that will enter into force by 2026. So those are some of the key things to answer your questions from a Moroccan perspective.
We have a very interesting experience in Luxembourg. My chair sponsor is ADA, and ADA is organizing direct investments in many developing countries, usually the least developed countries. And they engaged in a very interesting experience to transform a full region into eco-friendly agriculture. And what they figured out after they had invested a lot of time, that the farmers on the ground don't understand green, but they understand profits. So what it is important to set an ecosystem, a framework up where eco is more profitable. Then they will understand it. And that means we have to combine subsidies, private investment, blended finance, risk mitigation techniques, and so on, the full finance chain on which the farmers can rely, that they get tailored solutions. Because the farmer will not be an environmental scientist. That will never happen. The farmer will be a farmer, and that is the person who wants to feed his family by making a profitable agriculture business. Yeah? And so it's also not the demand for the eco-friendly services is in their own country. The demand comes from far away. And so these type of things must be intermediated through the financial system, through educational institutions. And here I believe, for instance, that microfinance institutions play an enormous role, in particular when they come in the MFI Plus model. That means where consultancy and advice comes on top of financing. Of course, we know that MFI Plus is more expensive than simple credit, but I think there's a good case for supporting these institutions, because they convey literacy, financial literacy, environmental literacy, also digital literacy on top of finance. And this is, in my experience, the most efficient way to slowly but surely educate the sector towards a new horizon.
I'm going to add just a very broad view from some of the wider AFI network. This builds on what Dirk has been saying. We can also see that there's been quite a lot around public education campaigns to advise people what classifies as green. Because as Dirk said, a lot of people they are undertaking activities that are green, but they don't understand the green terminology. So transferring it into locally understood terms and locally understood concepts instead of using perhaps international language can be a very effective way of being able to educate people. We've also seen in different parts of the network quite successful solutions where community groups and community leaders, and in some cases faith-based organizations, have also been engaged to be able to reach wider groups of people and in perhaps some of the more remote places than perhaps you would do with traditional outreach campaigns. And those have been quite successful. So I think this approach that Dirk had and what we've heard from the members, where you take a multi-pronged, really tailored approach that really links into your national context, is really important. But it's also about making sure that you meet people in the places that they are and speak that language that they speak and give them the incentive to be able to engage, because they know that they want to be able to have a better standard of living and they know that they want to be able to help their family. And if you then give them every reason to be able to do that, then it's much easier to be able to get people engaged. So thank you very much.
Thanks a lot. Other questions from the audience? If not, I have maybe a final one. One observation before we go to our concluding remarks. There seems to be this tension between regional approaches, both in taxonomies, but also in measurement of the data afterwards, as well as concerns, and international approaches when it comes to comparability of data, etc. So do you think, or in your view, do we need more an international framework for this, or are we better off if we want to reach impact with regional frameworks?
I am a strong supporter of local optimized frameworks which can be transferred to the global language. And I believe the solution lies in transparency of the differences. We have a research project at the other chair where we compare taxonomies and try to build a convergence score. And that will allow cross-border investments based on the convergence score. Yeah, so you can say 75 investment is sustainability compliant with the EU. That would immediately say that in the investment of the institutional investor, you have 75% sustainable investments, which is a great score. Yeah, so you can build on a convergence score, but a sustainability framework which only looks at the capital side without the investment side will just not be operable on the ground, because the taxonomies are just so widely diverging and all vested in the local optima. I think you have.
Yeah. Okay, I fully agree with the Dick, and just one line I would like to say: during the development of the sustainable finance policy or the green finance policy in our country, we actually see the international best practices, but we focusing our country context. Thank you very much.
From our perspective, as we are moving forward into developing a green finance taxonomy, we are trying to deal in a balanced way with this interoperability with international taxonomies, while also taking into consideration proportionality of the circumstances, local specificities, local challenges, to not just duplicate, for example, the European taxonomy that would be so complex for the local Moroccan institutions, but we should be at least comparable to those taxonomies without putting an overburden of this global transition dynamic on exporting activities, because many of financial institutions and corporates have also international partnerships. So we are trying to have this trade-off between the two components as much as possible, and exploring to our extent we can have something country specific but still not quite different from what already exists at the international level.
I think I'm just going to amplify what our members and Dirk have been saying. The AFI member-led, member-owned approach is very much that we look to have alignment and similarity where we can, but that we really do develop everything to the AFI national contexts. For those people that haven't ever used our data portal, we have a completely free to use data portal called the AFI data portal. You can register just using your email address, and then you can download all of our member data. We do hold a core set of data on there, which is comparable across our whole network, but then our members also upload their own national level data as well. And I think some of you may find that very interesting to be able to access some of that. So if you've never had a look at it, I do recommend that you just have a log on and access that data as well. And then you'll be able to see a lot of the different variances across not only our members, but across the regions as well. Thank you.
Thank you, Helen. Very good to highlight this at the end of the session as well. So I would like to invite the panel to conclude on one thing. If you have one advice to give to policymakers and stakeholders here at COP29, what would that one conclusive advice or word be on measuring inclusive green finance?
Thank you. In the COP29, policymakers should address the sustainability and the climate-related risks and opportunities in developing any policy. They should focus on more on opportunities than the risks. Otherwise, it may lead the exclusions. So the main sustainability and climate-related opportunities are new technologies-driven business and the consensual climate finance from the both domestic and international sources. The policies and the regulations should be developed in such a way that the risks can be overcome through the opportunities. To utilize the opportunities, in intensive awareness events and the capacity building are essential. So awareness raising events and the capacity building should be the integral part of the policies. Similarly, other stakeholders should focus on the opportunities to overcome the risks and enhance own knowledge, capacity to avail the opportunity, especially developing new technology-oriented zero-emission business and developing own capacity to access the low-cost domestic and international climate financing. So I believe the combined initiatives from all policymakers and the stakeholders towards the net zero, equitable, inclusive new economy will change the world a better and the sustainable world. Thank you.
I think the cooperation between the government and non-government organizations and financial institutions is important. FRC has been working with the international and domestic institutions, including Mongolian Sustainable Finance Association and IFC and AFI and the European Bank on Reconstruction and Development for the creating a long-term sustainable financial system, a green capital market and regulatory environment for the green bonds issuance. This initiative as just the beginning, we are commitment and continue our effort to ensure that our financial system not only withstands these challenges posed by the climate change, but also plays key role in the driving sustainable development.
I have two key messages for this COP. First, at the national level, to have common coordinated policies. We need market incentives, regulatory incentives, but also public policy development that are aligned at the national level to have this efficient policy mix for climate action and inclusive green finance. At the international level, I hope that the international community would focus more on adaptation finance, explore and put in place methodologies, models, financing schemes that serve the needs of developing and emerging countries, because we continue to see that only a minor part of the international resources within the Paris Agreement is actually allocated to adaptation finance, and this is even more alarming when we look at the specific regions. The African region attracts less, only I think 21%, according to an OECD report on the $100 billion that the developed countries should also support, put in place to support developing ones. Thank you.
I'm going to be very brief. When it comes to both policy and both data, we need to make sure we have better collaboration, both in country and cross region and globally, especially when it comes to data collection. There are vast amounts of data being collected and duplicated across the data aggregators, and there is ever such a lot we can do as a global community to enhance our data collection, streamline it, ensure that it's proportional, and ensure that it is inclusive and intersectional. So there is a really big call to go out to everybody like the World Bank, the IMF, the OECD, the ILO, and others to ensure that the data that they are collecting can be leveraged better without putting a burden on some of those people who find it really challenging to be able to provide it. And we also need to make sure that we have a lot more transparency in both the data that is available and the policy that is coming out, because I think that if we really are going to ensure that we don't leave anybody behind, there is a huge opportunity for much greater collaboration and much greater focus on the inclusive aspect of green financing going forward. Dirk, last word from you.
Thank you, Helen. Considering that impact investment is suffering from small investments, i.e. we lack scale, datafication is a key to increasing scale because it enhances comparability and datafied investment approaches so that the relative cost of investments go down. And I think regulators should focus on datafication in the sense that they find maybe super regional substitutes for data which they cannot collect on the ground, because many of the recipients of funding will be too small to generate these data. And here I think about technology. I think about, for instance, that we can use satellite technology for certain oversight things. We can use digital data flows for approximating certain elements. That sounds a bit abstract, but we have evidence, for instance, that we can monitor certain crop uses via satellite technology, and when we do it on a large scale, we can bring down the cost of monitoring, and that will enhance investment size. Yeah, so here I think technology, sustainable finance, datafication goes hand in hand. The one thing cannot live without the other. So we shouldn't think of sustainability as a main purpose, but of sound investment techniques. Thank you very much.
Thank you, Dirk. I think that was a sufficient closing remark. So thanks a lot to our panel. I'm very grateful for having learned a lot and for having you come here to share your knowledge. That was very valuable. I hope you also learned a lot and enjoyed the session. Have a lovely stay here at COP29. Thank you.